Hello and welcome back to my channel. Today I'm going to do a property analysis of a property based in KZN. It's a property in a trust, a commercial property with mixed retail and industrial use. The property has 2 tenants and the client provided me with information on income and expenses over the last 4 years. By having a few years historic data on the property, I had a good indication of the rental income and cost trends on this property. Repair costs were quite high in the last 2 years, and the client mentioned that this should be slightly lower in the next few years. With all of this information at hand, I managed to put a nice calculation together that can show us if this property is worthwhile keeping or rather to sell it and invest the money. The client provided various valuations of this property. Current municipal value was 13.9 million and the valuation done in 2017 was 16.8 million. The client also gave various valuations of his own, which are estimated values from 14.1 million to 19.4 million. I had to do a manual calculation to get to the true value of the property because some of the CGT or capital gains taxes was paid during a 2017 transaction. Thus, I deducted the CGT from the current highest valuation to get 18.441 million valuation on this property. Here are the assumptions that we are going to use in this calculation, the property value being 18.441 million. The 18.441 million is still considered quite high if we take into consideration current market conditions. The trustees did mention that current market conditions are not favorable and that maladministration and mismanagement of the municipality has caused it not to be as attractive as before. Now, once you sell a property, you realize what it's actually worth. If no one is willing to buy a property, then it is not worth that. The rental income we are going to use is 175,440. In the past, it shows that one of the tenants does not pay all their rent and that the landlord has to, or the trust has to, allow them this lenience. So we are going to use a 6% increase on the previous year, even though previous years there were 3.16% per annum only growth for the last 4 years. The expenses used in this per month is 56,990. This includes rates, taxes, maintenance, everything else. How did we get to the rental income assumption? 3.16% was the actual per annum growth of the current rent for the last 4 years. The trustees indicated that higher contractual rent for this year will be implemented. It's clear that rental income fluctuates and is not 100% stable. Thus, I took a 2023 rental income of 165,510 and added 6%, which is above the long-term average, giving us 175,440. In other words, if we take the past trend of 3.16% growth, we would say a 6% increase on the rent to assume for going forward is quite high. To keep the rental income annual increase realistic going forward, in other words, not the current 6% that we've used to start off with, we are taking the 3.16% and we're adding an extra 1% as a buffer to give the property benefit of the doubt. Thus a 4.16% future increase. How did I determine the property expenses going forward? So rates and taxes increased by 12.4% per annum over the last 4 years. The trustees indicated that bad municipal management played a big role. The repairs went up by 15.8% over the last 4 years every year. However, the trustees mentioned that the repair cost should be lower in the short term going forward. Thus, I'm going to use a lower property repair bill. Total expenses, the total expenses per month for the last 4 years went up by 11.85% per annum. That means the total expenses, including rates and taxes, repairs and everything else, even though the 2023 year showed more than 67,000 per month expenses, I did the following. I took the average repair bill of 19,000 instead of 29,000 over the last 4 years. Then I took the current rates and taxes because that's something that probably won't go down, it'll probably go up. And then without applying an increase for 2024, I took that current rates and taxes bill. So I want to give it a fair chance of being a good investment because, you know, I'm trying to compare it to a normal investment. Then what I did too, I took the average difference between the total cost and repairs compared to the other expenses, and we got an average of 56,990. So here we can see all the assumptions. We're going to use a property growth rate of 4.28%. We're going to use a rental increase per annum of 4.16%, which is 1% higher than the last 4 years average. Then the expenses went up quite a lot over the last 4 years, but we are going to use a 9% increase for that. I think that is quite fair. And then the tax rate on the rental income profit of 45%. Now that's the tax rate for trust. And when I do personal property ownership, then I use the marginal tax rate of the user or of the client in order to determine what tax will be applied. This is how I determine the expected growth of the property going forward, the actual capital value of the property. If we look at the REIT market, or the real estate investment trust market, which is listed properties on the JSE or listed property companies on the JSE, you'll find that the growth has been very absent. There's only a 2.28% growth over the last 10 years and only a minus 0.45% growth over the last 5 years. Now, I don't believe it will be negative going forward, but I still believe it will be quite sluggish going forward. The grey blocks on this table show that listed property did quite well over the last 15 years. Now, that includes the golden years, the real golden years where property did very well. And I don't see that coming back soon. As you can see, listed property performed the worst of all. Doesn't mean it will never do well again, but I don't think we're going to see property growth at a high level again. Property used to be a very good investment in the late 90s, early 2000s, and even the trustees mentioned that in the report. So here we have the detailed calculation. I'm just going to show this quickly. Some of you who've watched my videos before would see that this calculation is quite detailed. It shows every month a snapshot figure of what your cash will be or your profit will be if you sell your property. On the left hand side, let's just go through these columns. There's your month every month, and every 12 months shows a gray shaded row there. Here you can see your rental per month, your rental income increase. After 1 year, you'll see it goes from 175 to 182. That's 4.16% up, and so forth over 20 years. That's how long this calculation goes. Then rates, taxes, levies, all the expenses, 56. You'll see that goes up by 9% after 1 year. Accumulated levy paid. So this is actually accumulated costs paid. I'm just going to actually change it while I'm here. Right, then monthly cash flow. That's the monthly cash flow. So it runs a surplus, and there you can see the surplus increases every year as the rent goes up. The expenses also goes up, so it eats into your surplus as well. Anyway, then accumulated monthly cash flow. This is how much cash flow you build up, in other words, in a positive way. And then your property value or growth rate, 18.4 million. You can see every month it goes up. After a year, it has gone up by 4.28%. Then it ends up being 19.23, etc. As you go down, see that increase. On the right hand side is the net cash in hand at point of sale. In other words, that's the property sale price plus all the rental income less expenses that you've gotten over the years. Now, this does not include the taxes and all of that yet, and the CGT at the end of the property sale, but that's part of the calculation, and I'll show the final figures later in this video. We have to compare this property investment to something else. So the best way I find to do this is to compare it to an endowment, which is an investment that already pays the tax on your behalf. In other words, the taxes gets paid in the background if you're a trust, company, or an individual investing in this product. Now here you can see an investment where the deposit is 18.441315. In other words, that's the sale price of the property or the current valuation that we've used with the property calculation. And we're assuming, what if you sell the property and invest that money, what will it do over the years? Here you can see the balance. Here's the growth per annum. Every year you get a little bit more growth. The 10% is compounded, obviously. And then here's the cumulative contributions, which remains only the first contribution because you don't put any monthly contributions into this investment if you had to invest in it. And here are the balances. So this is the balance after 1 year, 2 years, 3 years. You can see every year, like let's say in year 15, that's 7 million growth just for that year. So you jump from 70 million to 77 million. Cumulative growth that you've received. And then on the other hand, here's the endowment after tax, personal and trusts. Will be that an endowment has its own tax. In other words, once you cash it out, there's no tax payable. And in this case, you will see after 20 years, it will be 111 million worth and so forth. For example, 5 years, 28 million, 10 years, 44 million, etc. Now, what are we trying to do? We're trying to take this value here and compare it to the property with the rental income minus the expenses and the taxes you have to pay on that to get to a figure. And let's see what the result is. So here we have the final comparison. On the left, you've got the years, then the property cash in hand, in other words, after rental income tax and CGT. So let's look at 10 years. If you keep this property for 10 more years, you'll be worth 34 million in that sense. In other words, you'll have rental income, paid the tax, paid the capital gains tax after the sale of the property on the increased value as it's grown over the years, and you'll have 34 million rand tax in your pocket. On the investment, 44,305,000. If we look at the difference on the right, it shows you the difference between these two scenarios. So the difference between the scenarios, as you can see, increases as time goes on. In other words, the investment scenario looks better than the property scenario over time. This calculation is quite technical. I don't go too much into the back end of the calculation to save time, otherwise the video gets too long. So I hope this is a nice balanced approach and that you appreciate this video. If you like it, please press the like button. And if you like my content and want future updates on my content, please press the subscribe button.